now. My name is Rob Neidhart. I'm a tax manager here at Layton, focusing on cost segregation primarily. And I'm joined by Will Whiteman, our senior consultant for cost segregation. So today, we're going to talk through a few things. First of all, we're going to talk through what cost segregation is, right? So we want to make sure everybody's kind of on the same baseline, talk through kind of how it works, how you claim it, how it can benefit you and your company, and why it matters to you, right? So we'll kind of start from the basics, work our way up through cost segregation as a tax tool. And then we'll hand it over to Will, who can talk through why engineering matters in a tax study. When we're looking at cost segregation, there are engineering factors or engineers that are working on the study for you. So we're going to talk through why that is when it's a tax process. And then Will's going to talk through a quick case study, kind of put numbers to it, try to put numbers to the words that we're talking through, so it's not just all hypothetical. Hopefully it makes a little bit more sense for you that way. And then we'll talk through quickly how we partner with your CPA. We don't replace your CPA. We fill a very specific role in the cost segregation study. So we'll talk through exactly how we work with you and your team to make sure that you can claim this smoothly, efficiently, and make the most out of what you're doing here. So what is cost segregation? Why you do cost segregation at its core is to immediately save taxes, right? Most of what we do in the tax world is to save money on your taxes. And that improves your cash flow, and cost segregation can enhance the return on your investment in your properties, right? So the idea here is you do a cost segregation study specifically to help, make your tax situation more efficient and take the most advantage of the properties you have. So how does cost segregation actually do that? So to kind of talk through cost seg, we have to understand first what depreciation is. I know some of you are in the tax world, so you probably know what depreciation is. Some of you aren't, but still know. So just kind of in the name of setting an even baseline, making sure we're all talking the same language here, we'll quickly talk through depreciation, and then that kind of flows up into cost segregation a bit. So depreciation, right? When you buy a building, when you buy really any asset that sits on your books, that asset's going to degrade over time, right? You buy a car, the more miles you put on it, the more wear and tear it's going to get. Especially in Boston, you get the salt underneath that car, it's going to wear away pretty quick. So depreciation is how we in accounting, put a value to that degradation in that property, right? The idea is your property that is not sitting on your books is losing value. Depreciation is how you actually record that. Depreciation deductions, the amount that you can claim on a year-to-year basis depends on the value of the asset and the class life that it sits in, right? So not every asset's the same. Not every class life is the same. So all the assets that you own or plan to own or have owned, they depreciate and they give you benefits in different ways. So typically the asset classes we look at, right? So as an example here, we're looking at a building and a vehicle, right? So you bought a building for $1 million, and you bought a vehicle for $30,000, or a nice pickup truck or something, whatever. Those two assets are very different things, and they last very different amounts of time. When you buy a building, you're hoping that it's going to last a lot longer than just a pickup truck, right? So depreciation on a building is going to last longer than depreciation is on your vehicle. The idea there, like I said, it represents that degradation of value to try to mimic the real world, right? So your building is going to last longer. So the class life on a commercial building is going to be 39 years. Class life on a vehicle is 5 years, right? The idea is that the vehicle after 5 years, not a ton of value left on it. So when it comes to depreciation, that building, that $1 million value, the depreciation deduction you can take in 1 year, theoretically, is 1/39th of that total value. Whereas for a vehicle, something that depreciates quicker in a faster class life, you can take 1/5 of that value as a deduction that first year. So this isn't exactly how it works. You have different types of accelerated depreciation, different depreciation methods, right? So when it actually comes time to do your depreciation, you can't just do 1 divided by 5. There's different methods. So this is more just kind of a high level look at how depreciation works, right? So in year one, if you had $1 million building, a $30,000 vehicle sitting at their 39 and 5-year class lives, straight line, that's about a $31,000 deduction in the first year. So your assets, while you can't just expense the entire value in the first year you got them, that value keeps returning year over year until you get those deductions year over year. So depreciation, right? At 27 and a half years and 39 years for commercial buildings, 27 and a half years for residential buildings, your buildings sit in some of the longest asset classes in the tax code, really, other than, land, which can't be depreciated. So I guess that class life is infinite, but your buildings are going to be some of the longest lived assets you're going to own, which makes sense, right? If you're going to own that building until it falls, it's going to last a lot longer than most of the other assets. But what that means is that when you include assets in those classes that don't belong there, you are vastly extending the class life and vastly decreasing the depreciation deductions you should be taking on those assets. So cost segregation at its core is identifying what actually should be in those 27 and a half and 39-year class lives and what shouldn't be, so that we can pull them out, put them in the class lives that they should be in, and depreciate them at that accelerated rate. Right. So cost segregation basically is depreciation supercharged, right? You get depreciation, you already have these assets, you're going to get some kind of a benefit if you just kind of drop them all into that 27 and a half or 39-year class life, but it's not everything that you could be getting or you should be getting. So cost segregation supercharges that depreciation that you can get on a year-to-year basis. Cost seg, it is an IRS approved method for accelerating depreciation. It's been around for decades now. There are dozens of tax law cases that have gone through the courts over the years that have kind of piecemealed and created cost segregation as we know it today. There's a few key cases. One of them, the biggest one is a Hospital Corporation of America case, which basically said that we can take principles that apply to the ITC and apply it to cost segregation. And long story short, basically said the IRS and the court agreed that you can break down a building into its components in order to more accurately depreciate those components. So when you're doing a depreciation study, it's really important that you're taking an engineering-based approach. In order to do an accurate depreciation study, you have to know what those assets are. So if somebody's looking at a building, they have no engineering background, or they just haven't spent too much time around buildings, it's hard to see the forest through the trees, right? You're just going to see a building. Because we take the engineering-based approach, we see the wiring in the walls, we see the carpeting, the different types of flooring, you see the different HVAC systems, how they work, what they do. And that's key to be able to kind of reallocate those assets and get the most out of those assets. When you do that, then you're able to change the depreciation rate on those individual assets. Like I said, you're pulling out flooring, you're pulling out electrical wiring, you're pulling out HVAC as much as humanly possible. And you're changing the depreciation class. So like we showed in that last table, you're getting it depreciated as quickly as possible so you can take those expenses, those deductions as quickly as possible. And the last piece that is really important and one of kind of the key factors, especially in the past few years, that makes cost segregation valuable is bonus depreciation. So bonus depreciation is additional first-year depreciation deductions that you can take on certain assets, right? The IRS or Congress really basically said, we want to encourage people to buy property. If you own property in asset classes with 20 years or less, you can take X% in that first year on top of what you normally would take. The amount of bonus depreciation depends on the year. So really, the default is no bonus depreciation, right? It's kind of an extra. From the end of 2017 through the end of 2022, bonus depreciation was at 100%. So everything that sits in those class lives of 20 years or less, which we'll kind of talk about in a little bit more detail here, the next couple of slides, of what it kind of sits where. Those years you can depreciate and deduct 100% of the value in those years. It's starting to step down. So 2023 bonus drops to 80%. 2024 drops down to 60%. It's going to drop down to zero at some point to go back to that default where the benefit of cost segregation is in accelerating those assets. But bonus, theoretically, as long as the tax laws don't change and all that, bonus depreciation, when it is in effect, really supercharges that depreciation because now you can take the entire value, not just in 5, 7, 15 years. You can take the entire value in that first year. So let's talk about those asset classes, right? So the big ones that we look at primarily for cost segregation is real property, land improvements, and personal property. So real property is a building or inherently permanent structure, right? So real property is that category that's going to depreciate for 27 and a half or 39 years. And it's kind of the default. If you buy a building, your accountant's probably going to drop it all into that real property category and depreciate it over 27 and a half or 39 years. It's also over that 20-year threshold, right? So any real property is not bonus eligible if it's sitting at the 27 and a half or 39-year life. Land improvements. Land improvements are depreciable improvements made directly to or added to land. So land itself is non-depreciable. So the entire value that we allocate to land, it just sits on your books as is. You can't take any depreciation deductions for it. Land improvements are what you do to that land to make it usable, right? So you buy a plot of land, you put a building on part of that land. The other parts of that land, you're going to pave for parking. You're going to put landscaping on it. You're going to put lighting outside. You're going to put curbing, sidewalks. You're going to put drainage. There's all kinds of things that you do to a plot of land to make it usable. Most, if not all of those, are going to fall into that land improvements category. Land improvements are depreciable over 15 years, right? So if you're looking at that class life compared to 27 and a half and 39, even disregarding bonus depreciation, you're still getting double the deductions just for shifting those assets from real property into land improvements. So by correctly depreciating those assets, you're getting twice the deductions for that portion of that asset. And then, of course, they're bonus eligible. So like we talked about, from 2017 through end of 2022, you can deduct 100% of that value in that first year, 80% in 2023, 60% in 2024. And we're talking place and service dates. So I want to make sure that's clear. So bonus depreciation, the dates where that applies is based on when that building was placed into service, not when you're claiming the cost segregation study results or, filing a 3115 and applying it to your tax return. So if you bought a building in 2021, 2022, it's not too late. You can still get that 100% bonus depreciation. That's a key factor there. And then the last category that we focus in on is personal property. So that's going to be anything non-structural, all the components within your building that aren't deemed structural that we can pull out of that 27 and a half, 39-year class life. So it's going to be things like furniture and fixtures, computers, peripheral equipment. There's all kinds of things that fall into that category, and Will's going to talk a little bit about that. Basically, anything within the structure that is deemed to not be structural, you can put into that 5 or typically 7-year asset class. So that is 8 times as fast, right? So the same idea. Even if you don't take bonus depreciation, you're still getting 8 times the depreciation deductions for accelerating those assets into that 5 or 7-year class life. And then add on top of that bonus depreciation, that extra benefit there. So the asset classes are really that puzzle piece that makes cost segregation work and makes it valuable to you. Taking as much as you can from their real property and doubling the depreciation deductions, or 8xing those depreciation deductions by correctly reallocating them into their class lives. So I'm going to hand it over to Will here. Or sorry, I'll keep going here. Sorry to spook you there, Will. It's still me. So let's kind of put that into an example here. So let's say you bought a building. You paid $1 million for it. You're depreciating it for 39 years. That's $25,600 about an depreciation deduction that first year. So that's where you start out, right? That's what we're looking at the beginning of a cost segregation study. You bought that building and you just started depreciating it at 39 years. When you engage us to do a cost segregation study, I'm going to send Will on site first of all. So he's going to be up in that attic looking around what's up there. And he's going to start identifying assets within that structure that can be reallocated. So what does that look like? So in this example, that $1 million gets spread out between building, land improvements, and personal property instead, right? Typically, you can see 15 to 30% to be reallocated. Of course, that entirely depends on the building, depends on your industry, depends on all kinds of things. So it can be as low as 0, it can be as high as 80% for all we know. But generally, it's 15 to 30%. So in this case, $200,000 of that building was identified as land improvements. So like we talked about, that accounted for paving the driveway, accounted for installing landscaping or lighting or doing something outside or drainage. So $200,000 was reallocated to that 15-year class life. Because this building was placed in service January 1st, 2021, that was a 100% bonus depreciation year. So all $200,000 of those land improvements are deductible in year one. So there is no waiting 15 years. It's just taken in that first year. And then $100,000 for personal property, very similar to land improvements, right? So that's personal property within the building that we identified as non-structural for a number of reasons, and then reallocated to that 5-year class. So because it's 5 years, that's bonus eligible. And again, 2021, so it's 100% bonus. So all 100,000 of those assets were able to be depreciated in that first year. So I just flip back one slide here. Oops. We started out with $25,000 of depreciation deductions. Because we're able to reallocate assets to more accurate class lives, you now have $317,000 of depreciation deductions in that first year that you're able to apply against income on your tax return. So that's what we're looking to do. So even though you're leaving $700,000, 70% of the costs in a 39-year class life, you increase your depreciation deduction that first year from $25,000 to $300,000, making that $275,000 available to you to reinvest in more properties, pay employees, do whatever it is you want to do with that money. You're not giving the IRS a 40-year loan anymore. You get to keep that in-house and use that for whatever it is you need to do. All right, now it is your turn, Will. Engineering-based studies.
Thanks, Ram. So like Ram said, I'm our lead engineer, senior consultant for Layton. And first off, I just want to start talking here about, what's the need for engineers when we're doing a tax study. So what's the need for an engineering-based study? So you may think, if you're not familiar with cost segregation, why do I have an engineer doing my taxes? Where's the crossover there? And the reason being is most CPA firms, most accountants, they're familiar with taxes. They're familiar with the high level asset classes and tax years, but they don't have the experience necessarily in construction and how things are built, the systems of a building, and how those are put in place. So CPAs, they can do a simple reclass of obvious items, but they don't have the level of expertise of breaking certain parts of a building apart into their respective class lives or asset classes and tax lives. So maybe if your CPA was doing a simple cost segregation breakdown, they would use estimates and rules of thumb, generalities, and it wouldn't be nearly as detailed as having an engineer come in for your building. And basically what we do is reverse engineer it. These buildings are already built. Usually an engineer's on the front end of construction, designing things, and we just do it the opposite way. We try to reverse engineer and figure out everything that was put into place in the building so that we can break it apart into the different sections. For example, the Ram mentioned these, and I have them listed here. And as part of the building construction, you've got cabinetry, interior finishes like flooring and wall coverings, and then you've got the landscaping, the parking lot pavement, sidewalks, all of that, and then the complex systems that run the building, the HVAC, plumbing, electrical, and any kind of specialty equipment that you may be using to manufacture your own product or anything like that. So it's important to use a specialty firm that, like us, that has engineers that work with the CPAs like Ram, to properly break apart your building, to reverse engineer it, to break it out into the shorter tax lives and asset classes, because that helps you obviously save the most money by getting the most detailed, and it satisfies the IRS like we talked about. It meets their criteria of breaking things apart the way we're supposed to. So moving into the next part, I want to maybe put this into a picture a little better, give us a better example of how this would look for an actual cost segregation study that we've done. So this one that we're going to look at look at right now, it's an office warehouse building. This is a pretty common building type for business owners that own their building that can take advantage of a cost segregation study. What we're looking at right here is, if from the aerial view, you can kind of see the lower roof line in the front. At the top of the picture is an office space, and then the higher roof line on the rest of the building is going to be a warehouse area. And you can see in the bottom right picture, there's a loading dock there to, to bring in, to export any kind of product that's being manufactured. So there's many similar building types to this layout. This one in particular that we're going to look at is, there's manufacturing being done. They're building their own product back there. There's lots of specialty equipment, but there's also a lot of building types, business owners that have a similar setup where this warehouse is maybe just empty distribution, lots of storage racks that are just being shipped out, and things are moving in and out. So not necessarily a lot of personal property in that warehouse. But so on this example, to kind of keep the numbers somewhat clean, and they're pretty similar to what we actually did here. And it was a $3 million purchase price in 2023, which, based on what Ram talked about, 2023 placed in service would fall in the 80% bonus depreciation. So we can take 80% of everything that we reallocate as a first year deduction. So in this example, we were able to reallocate about 15% of the purchase price, which is $450,000, and that would be the deduction that we would get to take. And then 80% of that would be about $360,000 that we're taking in as a first year deduction, because of the cost segregation, that we were able to segregate the different assets apart. So looking at this example, we'll look at the outside here of these exterior pictures first. And based on what Ram kind of already went over, the two main groups we're looking at is land improvements at 15-year, and then personal property of the interior building at 5 or 7-year. And you can see in this aerial photo, you've got asphalt parking lot, and then you've got curbs, sidewalks. There's light poles there for the site lighting, and there's also storm drainage. You can't see all this necessarily from these pictures, but there's the manholes for all the storm sewers. All of these things, the landscaping that they've done to improve this land, can be taken as 15-year land improvements. So that would be, of the 15%, that'd be a big piece of it, because those things are expensive. 6, 7, 8% maybe of that 15% that we are able to reallocate would come from these land improvements. And then going to the next slide, we'll look. I've got a few more pictures here of the interior. So like I mentioned, the front part of the building was office space. So you can see here, there's some cubicles. Personal property that we'd be looking at here would be like the luxury vinyl plank flooring, the rubber base around the edges as well, and any computer equipment, electrical equipment that's serving the office. We can take all of those things at 5, 7 year as personal property and accelerate it much faster than the standard 39-year that this entire building would fall under before a cost segregation study. So looking at the other pictures I have here, the middle bottom picture is a break room. So this, another portion of the office area. It's got flooring that we could take. There's a small cabinetry area with a sink that we can take that would fall under the plumbing category. Electrical that's serving those vending machines, and maybe a garbage disposal in the sink, or the ice machine and the breakers behind them. We can take all of that and reclass it into shorter tax lives and accelerate it at 5 or 7 years, compared to, like we talked about, the original 39-year. And then jumping to those the warehouse pictures, you can see there's a lot of specialty equipment in this example. And so there is manufacturing, electrical. So the electrical to run the manufacturing equipment, compressed air piping, plumbing, that's for any kind of wash that's being used for the manufacturing, and any kind of other equipment that's really bringing your product that or whatever you're doing in your business, from A to Z. So outlets for any kind of other equipment, forklift chargers for moving for your forklifts that are serving your business. Just all those things we can reclass into shorter tax years, and with bonus depreciation, take most of that in the first year. So I just want to emphasize again, like, this is a popular example, but and Ron mentioned this as well, there's several building types. If you're like a residential real estate investor, you have a lot of apartments, your percentage is going to be different than the 15%. It's going to, if you have a medical office, if you have you're a doctor or something like that, a medical office is going to have a higher percentage than a warehouse, because so much of the structural costs are real property that we can't accelerate, that the percentage ends up being lower. Whereas, a 5-story office building or a medical office, there's a lot more, and you can get closer to 20, 30% of your basis reallocated into shorter tax lives, which can be accelerated, and your deductions bigger. But either way, no matter your business, no matter your building type, no building's the same, but we can get close in our estimates based on other building types, but they're all usually going to be great cost segregation opportunities for the business owner, as we're able to take a healthy percentage there, accelerate it, and with bonus depreciation, give you a big deduction first year, and you can use that money that you've saved from your tax savings and put it into your business today, and that'll help benefit your business and or the building or whatever project that you would put it towards. So yeah.
Awesome. Thanks, Bill. Yeah, just looking at those pictures, I mean, that's where let's go back, where the engineers of the team really make their hay, right? You look at those pictures, there's all kinds of machinery there. Pretty easy to identify machines and throw them into an asset class, but you look at the electrical conduit that's running to it, you look at the HVAC that's running to it, that's required to run it. A lot of that stuff can be accelerated. So when Will's taking a look at a building, because he has that engineering background, he knows how to identify what kind of power is needed for that machine and how it's actually powered, and make sure that you're getting as much out of that building as possible. So how do we actually partner with your CPA? So like I mentioned, we work with your CPAs. They're filing your taxes for you. They know your situation. They know your general tax situation. What we know is cost segregation. We know how to tell you to take your building and reclassify into more efficient tax asset classes. So there's 4 main kind of steps to how we partner with your CPA or your tax preparer, your finance team. First one, and the biggest one really, is the kickoff communication, right? So when you're kicking off your study, you're taking a look at a building that you have, we want to make sure that it makes sense for you, right? We don't want to do a study if you don't have any kind of benefit from it, or there's something in the way from making sure that you can use the study. So we take a look at 4 primary things, right? So we want to look at length of ownership, interactions with other credits and deductions. We want to look at the value add proposition and tax position. So the reason these matter, right? Length of ownership. Depreciation is great. If you don't own your building long enough, there is depreciation recapture that you have to look out for. So typically we want to see that you're going to own your building at least 3 to 5 years before you sell it, to make sure that this is still a viable product for you, to make sure it's still going to benefit you. We want to make sure there's no, negative interactions with any credits, deductions. There's all kinds of things out there. Historic tax credits, there's low-income housing tax credits, all kinds of funding sources. So you need to make sure that they're not going to interact with each other. One's not going to negatively impact the other. So that's something we take a look at right at the beginning, make sure that that's all squared away before anybody spends too much time. And there's the value add proposition, right? We want to make sure that we're adding value to your business. The way we do that is look at the value of your property first and foremost, right? So the benefit of a cost segregation is largely dictated by the cost of your property, the cost of your building. you can't reallocate more than is there. So we want to see that a building is going to be originally purchased or built for over $1 million. Anything below that, because we have to allocate to that non-depreciable land that we talked about, and because the percentages start kind of getting smaller and smaller, it might not be worth your time to go through the full cost seg study. $1 million and up, there's probably a good chance that it's going to be a value add for you. And then tax position, right? We want to make sure that you actually are planning on owing taxes to use these deductions, right? Deductions aren't very helpful if you don't owe taxes because you're already in losses for a bunch of years. So if you are expecting taxability, now or in the near future, it's best to get your deductions sorted out to make sure that you don't have to pay more than you need to. But we want to make sure that you have the opportunity there to use it. And then we work with your CPA and with you to make sure that we're collecting documentation as efficiently and smoothly as possible. Nobody likes digging through their files from 10 years ago. So a lot of times CPAs have their stuff pretty organized. So we'll work with them to collect your depreciation schedule, anything else that they might have, and then work with you to collect any kind of plans, anything like that. So we partner with your CPA to make sure that we're taking up as little of your time as possible, so you can benefit from this without spending too much time. Deliverables. So after a cost segregation study, you want to make sure you can use it. So what we deliver to you and your CPA are depreciation schedules. First of all, basically, this is what your depreciation schedule looked like. This is what we changed. This is what it should look like now with all the reallocations. And so you have it spelled out for you and your CPA to make sure that you can plug that into your tax return and use those deductions easily. And then we also include a narrative report, and that steps through all the tax law that goes into this thing. Like I said at the beginning, cost segregation isn't a nice, neat credit deduction. It's not just one section of the tax code. It's a collection of tax laws and tax precedent. So our narrative report steps through all the important pieces of that tax law that allows the cost segregation and steps through your project, right? So there's a little bit more specific information about why your project was a good one for a cost segregation study and why your assets were available to be reallocated and kind of where you got that benefit from. The idea being, if you ever had to take a look back at your study, you could read this narrative report and know exactly why you claimed the way you did. And then lastly, filing guidance. Not everybody's done a cost segregation study. Not all tax preparers have seen this, have filed a 3115 or the related, tax forms. So we work with your team to make sure everybody kind of knows what they're doing, knows how to take advantage of it, and can file it so that you can take advantage on your next tax return and not have any issues with it. So start to finish, we work with your CPA to make sure that your time is being spent where you can make the most out of it. It's also spent with your CPA to make sure that they know exactly how to do this. And again, their time is spent wisely. And so at the end of a cost segregation study, you just have a nice, easy to claim deduction, and you can apply to your next open tax year and limit how much income tax you have to pay. That's all we have for you. So